Some of the most well-known capital market anomalies are the day of the week effect, also frequently referred to as the Monday effect. This effect refers to the situation that prices tend to fall on Monday in the United States and on Tuesday in Australia. The January effect, prices tend to rise in January. And the size effect, small stocks, shares issued by small companies, tend to outperform large stocks. These phenomena don't occur all the time, but they occur more often than they should on the basis of chance alone. What possible reason could there be for the Monday effect? One reason that has been advanced is the fact that bad news is often released after the closing day on Friday. If companies releasing bad news are fearful that there might be an overreaction to the bad news, pushing down share prices unnecessarily, then it's logical that they would wait until the end of the day on Friday to release that news, which gives investors 2.5 days to contemplate the effect of the news and perhaps, hopefully, not overreact. Maybe this works. Maybe there is less of a reaction than if the bad news had been reported during a trading day. But the fact remains that if bad news is often released at the end of the day on Friday, then that would result in a decline in prices on Monday. The reason that we have a Tuesday effect in Australia is simply because our market often reflects what happens on Wall Street. So because of time zone differences, what happens there on a Monday affects our market the following day. What about the January effect? What reason might there be for this? Many people cite the tax loss selling hypothesis. This is based on the fact that the end of the financial year, or the tax year, is the 31st of December in the US. If you're a US investor and you have a poor performing stock that you're thinking of selling in the near future, it makes a lot of sense to sell it in December rather than January, because then you get the benefit of the tax deduction 11 months earlier. The size of the tax deduction doesn't change, but as we know from the time value of money, a positive cash flow sooner rather than later has greater value. Therefore, the selling of stocks in December, pushing prices down, leads to a relative increase in prices in January. Once again, the fact that the Australian market often mimics what happens in the US means that we also have a January effect, even though that's not the end of the tax year in Australia. We would expect to see a July effect, and we do. The end of the tax year in the United Kingdom is the end of March, so you would expect to see an April effect, and there is. What about the size effect? What possible reasons could there be for this? The evidence seems to show that small stocks achieve abnormal returns compared to large stocks. This raises the question of how we define what is normal and what is abnormal. Many studies use the capital asset pricing model to determine an appropriate or normal risk-adjusted return, but there are problems estimating the beta for small stocks. Some suggest that this and other pricing models don't accurately reflect the risk of investing in small stocks. Maybe small stocks are riskier, pricing models that we use don't adequately capture that risk, and if they did, then the return that we are getting from small stocks is normal, taking into account their level of risk. So could the market be efficient despite these anomalies? For the day of the week effect and the January effect, it has been suggested that transaction costs prevent traders from taking advantage of these phenomena. And if so, if it is impossible to make an abnormal return despite these apparent anomalies, then we would consider the market to be, for all practical purposes, efficient. The size effect, as was mentioned previously, may occur because we're not accurately taking into account the risk of investing in small stocks. So these are two possible reasons why these anomalies could persist and yet the market could still be efficient.